Mr. Nazeem Noordali. Mr. Noordali is the General Manager, Corporate and Structured Finance of International Islamic Trade Finance Corporation of IDB Group. Mr. Noordali, how has access to Islamic financing facilitated South-South trade or trades between developing countries or emerging markets? And what role did export-import banks and guarantee funds play, if any?
Thank you very much. I would like, first of all, to thank ITC for inviting us for this forum to be able to elaborate more on ITFC and IDB. As we know, ITFC is a subsidiary of the Islamic Development Bank. And by the name Islamic Development Bank, we mean Islamic development. Islamic means we do the banking according to what we say, Sharia, principle of Sharia, and development, which means we are involved in development like other multilateral institutions. Before I start, I want to know how many people know about Islamic banking. Those who know, can they raise their hand? So quite a number of people know about it. And who has been able to practice Islamic banking either as a banker or as a business operation? Raise your hand, those who have done. All right, thank you. So we have at least 2 persons. So maybe for an explanation, I will give a crash course on Islamic banking, just to say what does that mean. The basic idea of Islamic banking is about providing facility money to the real economy. We don't trade money for debt. We have to have an underlying asset all the time for providing a financing. That's what the basic idea is. For us, is giving money for debt is like rental of money, which is prohibited under the Sharia, which is the Islamic principle. Therefore, in itself, for those who are not in Islamic banking, what we do is we call it Sharia compliant, or we call it, in more general term, ethical banking, because there's a lot of things behind it, like we don't finance products that are harmful for the economy or for the community and people. So now, why we're going to talk about Islamic banking and South-South trade? If we talk about that, I need to explain to you the establishment of the Islamic Development Bank. When it was established in 1977, the Islamic Development Bank was created by a number of countries spanning from Asia to Africa and Middle East. So we have 3 regions involved. These countries are either emerging economies or many of them are least developed countries, like in Africa. So the challenge for a bank like IDB at that time is how to provide development where most of the members are really poor countries. And in terms of trade, at the very beginning of creating of the IDB, the trade as a financing was created. It was the only multilateral that started trade from the beginning, 1977. More than 35 years of experience in trade finance. And this trade is between Africa, Asia, and Middle East. We are not talking about just Africa and Asia. We're talking about also Middle East. So we have the expertise to work in the three regions. So when the trade was created by IDB, over the time it evolves. And by end of 2007, before the crisis in 2008, we had a portfolio of trade finance for South-South trade, I would say, about $1.6 billion. And ITFC used to be a trade finance department in IDB, become a complete autonomous entity in January 2008, all right? And now we are nearly 5 years old. That same portfolio now is nearly triple. It's $4.4 billion. Just to show you the importance of trade as given for the IDB group in general. So, by the sheer number of the volume of business, is show you how important for us trade and access to trade to our member countries. Now, with the financial crisis happening, what we noted that trade is not done by itself. Trade needs financing. We found out that trade had a problem. No good was moving because nobody wanted to accept a letter of credit coming from banks that they think that will go bust anytime. So trade finance, which was taken for granted before, now has become very important and become an issue of discussion in many different international panels. Because if we say trade is an engine of growth for economies, trade finance is that fuel for that growth. So you badly need trade finance, and you need to put the trade finance where it should be. In ITFC, we work directly with corporates, with direct borrowers. We don't provide financing. Our model don't provide financing to banks. We put the money where it is needed. Because where it is needed, that is, the international business today has differentiated needs. We need to do where the money should be. We need to put the money where the requirement is needed at the proper time. So that's why we believe into, like commercial bank, we go directly into corporates. Now, I'm not talking about Islamic banking in general. I'm not talking about ITSC, which has a leading role in Islamic trade finance, right? But otherwise, today, in the whole Africa and Asia, even Europe, you have more than 600 Islamic banks in over 75 countries, having a total portfolio exceeding $1 trillion. Still small compared to conventional banking. But if you see what it come from 15 years ago, this is a tremendous growth over more than 15 years, above 30% in average. So this is about Islamic banking and also their effort, private sector banking in their effort for contribution to trade. Now, with the financial crisis, what we noted is a lot of, as Michael said before, is a lot of banks pull out the liquidity from the emerging market. This was noticed. This was a drastic drying up of liquidity. And that's how multilateral joined in to try to bridge the gap. We also join in our own way. But when we saw the requirement, how we can contribute to help our member countries in Asia or Africa or Middle East, is to change our business model. Instead of doing conventional import-export financing, we move into structured commodity finance, right? Where we move into providing the liquidity where it is needed. That's the whole concept. Now, what we notice nowadays is major bank considered as big bank has pulled out in this market, Indonesia, or in Asia, in Africa. It has been replaced by other market entrants from the Gulf, from Asia. We saw a Chinese bank a lot in Africa. We saw Gulf bank in Asia, and so on. These people are coming up to take over this position. Right. Well, these have been left open, so people come in. It's market competition. But more importantly is what we notice is not just South-South trade, But we see what I call it East momentum. A lot of banks from the East, which means, for example, from the MENA, Middle East region and Asia, are joining hands, are participating. Investors from Middle East are coming to bank in Malaysia, Indonesia. So this is what I call East momentum. This is growing. This is the new banking order you will see in the future. Right. What is important also is, when I said new business model, trade commodity financing, we have been helping also a lot of the corporate in Asia, in Africa, and even Indonesia. For example, in Indonesia, we have been providing export finance for coffee export in a model of trade finance where the commodity is a security, and these are done within a framework of what we call it fair trade network. This is a very successful story of a small financing that we have given for coffee processors and cooperative in the island of Sumatra. That is what happened in Indonesia. But we have a lot of financing we have done in Africa going to Asia for cotton. We have done a lot in cotton. Some of my colleagues from African Bank have done also. How they bridge the gap between Africa and Asia. And what is very important is to understand the risk that is perceived. Right? To be able to do trade between emerging markets, emerging economies, is to understand each other, to be comfortable with others on how they can add value and how people like us, banks, intermediaries, can add value to that. Right? As we all know, for example, Indonesia is a big cotton importer. A lot of spinning mill here, but they don't buy cotton directly. They buy cotton through traders in Europe, right? But they have never gone into Africa or somewhere in Central Asia to buy cotton. How can we bring them together? How we can bring them together is one of the important components of it, is to provide a facility for the African producers to be able to sell. What are the challenges? Is access to market, we know that. Access to capital, access to finance, and access to capacities, I mean in terms of human capacities. But financing has proved to be a very important component. We, people like us, contribute, facilitate the trade, right? We cannot, if they want, there is a willingness to do trade, we can only bring them together. When they come together, we can provide a facility. Obviously, but this is very important, all right? How can we, in the future, be able, for a cotton producer in Africa, selling directly to a spinning mill in Indonesia? These are the challenges that we have to take. To do that, we need to be involved in complete supply chain finance. Also, this is one aspect. Now, how Asia can sell to Africa, to Middle East? This is how also we are involved. How to bring the comfort to the business. So, in a nutshell, the challenge to trade is also about the infrastructure, trade-related infrastructure to be built around, trade support policies, right, to help the countries to be efficient in their trade, access to finance, as I said, and the information, access to information and market information between them. Mm-hmm. So, yes, if we talk about Islamic finance has done a lot for providing financing to the trade between developing countries. We have done ourselves, we contribute a lot in leading some of the big syndication for trade finance in Asia and Africa. And within the IDB group, we hope to be able to increase more with a vision to be the leading Islamic banking operator, bank financial institution for bridging the gap between Africa, Middle East, and Asia. Okay. Thank you very much.
Thank you, Mr. Nazeem Noordali.